First, I would like to express my heartfelt gratitude to Pastor Poju and the Covenant Nation for the honor of inviting me to speak at such a distinguished gathering as the platform, and in company of such a great array of speakers. So in 6 days, on October 7th exactly, I'll be celebrating my 50th birthday. Thank you. So I guess I share the same number 7 benefits with Mr. Odegbami. But birthdays have a way of compressing time, often causing us to pause and reflect on the past with a renewed sense of purpose and a familiar resolve to grow wiser and to live more intentionally. Today, October 1, is not just a personal milestone, as we know, it's our country's Independence Day. And like any individual birthday, it is a collective moment to reflect on how far we have come as a nation and also to envision the future we are working to create. But it also calls for an honest assessment. What have we learned? What must change? And where do we want to be when we reach the next milestone? So it is therefore fitting that I've been asked to speak on the topic Reform and Resilience, Strengthening Nigeria's Economic Foundations. Just like Mr. Odegbami, when Pastor Poju picked this topic, I sighed, because that was the most difficult of the list of topics. And I was saying I should have just given one that was easy. It's extremely broad, it is extremely controversial, and then going by Dr. Ndidi's lecture, she's put me in a very difficult position as well, given the tricky nature of that topic. But I think it also encapsulates the essence of our national endeavor, particularly in recent times. And my late mom taught us that the first step to solving a problem is to be honest about it and then act to fix it. Neither denial about our reality in our individual lives or as a nation, nor acknowledging all the challenges but sitting down to just complain about it doesn't change anything. It's only when we acknowledge the truth can we take ownership and then act to bring real change. And I think this is rooted in the definition of reform, which simply means to me making changes to improve something. Now, reforms are not designed to be merely political shifts or adjustments. They are meant to be deliberate, strategic decisions made by a nation committed to stabilizing its present and securing a prosperous future. They, however, do not yield instant prosperity. They require patience, they require persistence, and they require disciplined execution, as well as the capacity to execute and follow through. It's like the personal commitments we make at the start of a new year. You remember the common goals like, take for instance, a common goal like weight loss. We know that lasting results often demand consistent effort, sacrifice, discipline, and endurance, often long before any visible change occurs. But if we stop after a few weeks, or give up because it's too difficult, or just lose interest, then of course the goals will not be achieved. So now, Nigeria is 65 years old, but our economic story after 65 years is unfortunately still described as a paradox. On the one hand, we have immense potential, which is well recognized, very well documented, frequently discussed. It is the reason that despite our often, sometimes difficult business environment, you can see I said often first and I changed it to sometimes because I was looking at Dr. Ndidi, and I'll be doing a lot of that throughout my presentation. Pastor Kojo has drawn the line, and we all have to align with that. So on the one hand, we have immense potential, which is well recognized. It's the reason that despite our sometimes difficult environment, foreign investors continue to engage with Nigeria. So while some may stay and navigate those challenges, others may leave temporarily or even permanently or delay entry. But whatever the case, they rarely lose sight of this market. They monitor us closely, waiting for the right opportunity or timing to return or invest, because they understand if Nigeria can get just a few fundamentals right, this is a market of immense scale and opportunity, and it's one that they just can't ignore. Take our demographics, for example. The population estimated at about 223 million, of which over 70% are reportedly under the age of 30. This means Nigeria possesses one of the largest reservoirs of youthful energy, creativity, and ambition anywhere in the world. Demographers call this a potential demographic dividend, which, if properly harnessed, could fuel one of the fastest economic transformations of this century. However, if neglected, it could become a demographic burden, fueling unemployment, social unrest, and out-migration. Consider also our natural resource wealth and geography. We are richly endowed with huge oil and gas reserves, vast agricultural land, and strategic minerals like lithium, rare earth metals, and many others that are shaping and will shape the industries of the future, from electric vehicles to advanced electronics. Our 922,000 square kilometers of territory includes some of Africa's most fertile farmlands. Our coastline and favorable climate position us as a natural logistics and trade hub for the African Continental Free Trade Area, whose market spans some 1.4 billion people. And yet, alongside this abundance, lies a country whose productivity still remains below potential. Our global competitiveness is still fragile, and inclusive growth has been elusive. So 65 years after independence, the gap between our extraordinary endowments and our actual economic and social outcomes is still very, very wide. However, when we strip this paradox down, the issue converges on one point: capacity. Nigeria's resources and demographic dynamism by themselves do not generate prosperity. Our immense potential means very little without the institutional and economic systems and capacity to realize it. So the central question is not whether Nigeria has potential, we clearly do, but whether we can build and sustain the institutional, infrastructural, and human capacity to translate that potential into tangible progress. Meeting this challenge, however, demands more than incremental policy tweaks. It requires intentional, economic-wide reforms, including strengthening public institutions, investing in transformative infrastructure, and designing financial and industrial ecosystems that convert our raw endowments into jobs, innovation, and globally competitive industries. It requires genuine inclusion and an unwavering commitment to doing the right things for the right reasons at the right time and in the right way. Only through such disciplined execution can Nigeria convert its exceptional promise into shared prosperity, ensuring that our country's youthful population and natural wealth becomes engines of sustained growth rather than sources of unfulfilled aspiration. So we have introduced a series of challenging and painful reforms recently, but which to me are absolutely necessary and beyond dispute. And I believe there is really no credible alternative. I also believe that if they're executed with consistency and integrity, they represent the essential first steps in turning Nigeria's long acknowledged potential into real, broadly shared prosperity, felt not only in statistics and speeches, but in the daily lives of our people. The challenge, however, is to ensure that the path of reform is as painless, humane, and well-sequenced as possible. But too often in Nigeria, this has been overlooked or maybe poorly implemented, resulting in what I think are avoidable hardships. So the responsibility of government is not to avoid these reforms, it has to be done, but to sustain them while urgently cushioning their impact by improving social protections so that the journey towards transformation is both economically sound and socially just. So over the next hour or so, I would argue that well thought out and well sequenced reforms are essential not only to stabilize Nigeria's economy in the short term, but also to future-proof it for generations to come. Drawing on lessons from our own history and from comparable nations that have successfully transformed their economies, I would outline how Nigeria, through credible reforms, can strengthen its foundations, build resilience, and achieve truly inclusive prosperity. In doing this, I will examine the reforms, some of the reforms underway, why they matter, what has been achieved, what we have fallen short, where we are falling short, and what must come next. Above all, I want to underscore resilience, how the difficult decisions we make now can fortify Nigeria against future shocks and lay the groundwork for long-term prosperity. Reform anywhere in the world is never easy. It demands vision, it demands sacrifice, it demands disciplined execution. But as I hope to show today, well thought out and steadfast reform is the surest path to a more stable, prosperous, and self-reliant Nigeria. So on this 61st anniversary of our independence, my message is actually one of hope, but not just hope in itself, but hope firmly anchored in action. So like I already stated, Nigeria is a nation with immense potential that has yet to be fully realized. Between 2015 and 2024, for example, our real GDP growth lightly stagnated and per capita income contracted, eroding living standards. During this period, millions of Nigerians were pushed into poverty, squeezed by persistent high inflation, rising unemployment and underemployment, even as 3 to 5 million young people entered the labor market annually while job creation lagged. Now, because job creation had consistently lagged labor force growth in the absence of effective unemployment-related social protections, it began to push many young people into low-skill, low-pay work, and also triggered a steady and troubling brain drain as some of our brightest minds and most capable hands started seeking opportunities abroad. This deterioration, however, extended well beyond income. Core social and economic indicators also weakened across board. For instance, the Human Capital Index, which is a measure of the future productivity of today's children, remains among the lowest in the world, with the most recent index suggesting that a child born in Nigeria in 2020 can expect to reach only about 36% of his or her productive potential, given current education and health outcomes. Today, roughly 40% of Nigerians, some 89 million people, are estimated to live below the poverty line. This is the second largest, assuming those numbers are correct, this is the second largest population of people in poverty worldwide after India. To grasp the magnitude of this number, we can consider that fewer than 20 of the world's 195 recognized countries even have a population larger than just Nigeria's estimated number of poor. And these dynamics are compounding. Together, these trends threaten the very promise of independence, that every Nigerian should have the opportunity to thrive at home. So what went wrong? Well, there are many reasons, but a large part of it lies in policy missteps and costly delays in implementing needed reforms. Key adjustments, some finally underway, should have begun over a decade ago when warning signs were already evident. And acting sooner would have significantly softened the impact on households and businesses, sparing the economy years of compounding fiscal and inflationary pressures. Instead, distortive monetary and exchange rate policies lingered, eroding investor confidence and choking off investment. Fiscal deficits also widened as oil revenues fell and unsustainable subsidies ballooned. Furthermore, external shocks the COVID-19 pandemic, various global commodity swings, the Russia-Ukraine war, and so on. It hit us hard, and we lacked the buffers to cushion the impact. The result was slower growth, deepening hardship, and a widening gap between our vast resources and the prosperity our citizens rightly expect. Encouragingly, we have recently begun to pursue some of these long overdue reforms. And while these initial measures have yet to bring broad relief to households, they have already averted a looming fiscal crisis. They have improved the profitability of many domestic businesses, and that they have begun to rebuild investor confidence. These are early signs that the economy's trajectory is shifting in the right direction. Much, however, remains to be done to consolidate these gains and translate them into tangible benefits for all Nigerians. To understand the urgency of reforms, especially some of which have been done recently, we must first recognize the depth of dysfunction embedded within Nigeria's economic structure. For many decades, our heavy reliance on oil exports had left the economy dangerously undiversified and vulnerable. As of 2023, oil and gas revenues accounted for more than 67% of government revenue and more than 88% of exports. And though oil itself is just about 5% of our GDP, it nevertheless drives about 80% of economic activity through its influence on spending, investment, and foreign exchange. In fact, it is because the oil sector was in recession for most of the last decade that our growth was muted. And now that the oil sector has started to pick up, we are witnessing stronger growth numbers. Consequently, every oil price or production shock, such as in 2014 to 2016 and in 2020, has triggered recessions and intense pressure on the naira, keeping growth subdued for most of the past decade. However, even when global oil prices surged in 2021 and 2022, our country reaped little benefit because years of underinvestment, persistent production shortfalls, and an unsustainable, costly petrol subsidy absorbed virtually all of the oil windfall. By 2022, NNPC's remittances to the federal account had collapsed to near zero, and the subsidy bill threatened to exceed $16 billion. At the same time, foreign exchange policy at the time compounded the problem. Multiple exchange rate windows and an overvalued official rate discouraged investment and spurred rent-seeking, while dollar shortages started to strangle businesses. Meanwhile, deficit monetization by the central bank drove inflation to double digits well before subsidies were lifted or exchange rates adjusted. By early 2023, mounting debt services costs and shrinking revenues had brought the country to the brink of a fiscal and balance of payments crisis. These macroeconomic stresses translated into real hardship for majority of the population. Inflation near 25%, eroding wages and pushing an estimated 7 million more people into poverty in 2022 alone. As food and transport costs soared, as insecurity and climate-related disasters increased, such as the floods in 2022, all conspire to deepen our vulnerability. Now, I'm not recounting all of this to spoil the celebratory mood of our independence. Rather, it is to underscore the reality that our old economic playbook had become unsustainable. By 2023, Nigeria stood at a fiscal cliff, and decisive action became necessary. We could no longer afford to kick the can down the road. The cost of inaction was spiraling out of control, and something had to give. So over the past 16 months, we have embarked on what I believe are significant economic reforms, all aimed at addressing precisely some of these structural challenges. Now, several commentators have used the words bold or courageous to describe the reforms that were introduced. And depending on your vantage point, you may agree or disagree. However, I always tend to hesitate to describe them as simply acts of boldness or courage, because to be honest, there was nothing else we could do at that point. It was a decision we are forced into, and that's why, if you remember, during the last elections, virtually every political party insisted that what we did actually needed to be done. To me, bold to me would be taking a risky path out of several less risky and equally viable options. But when your policy choices shrink to a single credible route, what appears as bravery at its core is an acceptance of necessity. So it was more like we were at a crossroad and picked the right route, as opposed to, you might say, perceptive action from a list of various possible and credible options. But then again, we did have the option of capitulation, which we did not pick. So I guess it still needed an act of resolve, an act of determination, and the courage to face the reality, without which we may not even be celebrating our 65th anniversary as a nation today. So the first of these reforms, as we all know, was the removal of petrol subsidy. Few policy decisions in Nigeria's history has been as fiercely debated as the removal of petrol subsidy. For decades, subsidies were portrayed as some form of social security and a shield protecting ordinary citizens from global oil price swings. In reality, they created a fiscal burden that simply drained colossal sums, often more than we spent on health and education combined. Then it created market distortions, artificially low fuel prices acting like a magnet, pulling fuel across our borders into neighboring countries, often leading to supply gaps domestically. So smuggling, corruption, and inefficiency became entrenched, undermining domestic supply and distorting incentives for investment in the energy sector. It also created equity concerns. Evidence showed that wealthier households who owned more cars and consumed more fuel captured the lion's share of the benefits. Meanwhile, the poorer households who spend a larger proportion of their income on transport and energy often stood in long queues or paid higher black market prices. So instead of leveling the playing field, the subsidy simply deepened inequality. So ending this practice was a needed act of national discipline and fiscal realism. The immediate consequences were undeniably painful. Transport fares rose, inflation spiked. However, some of the long-term gains are already becoming visible. The budget deficit has narrowed, opening up the possibility to redirect billions of naira to productive investments. Equally important were the structural benefits from eliminating the subsidy. With the end of cheap fuel arbitrage, smuggling to neighboring countries is far less lucrative, and I believe over time, the domestic market will stabilize and incentives will shift towards investment in infrastructure, power, and social services. So this reform was not just about balancing the books. It was about freeing Nigeria from a cycle of dependency and vulnerability. But like I said, it was painful, but necessary. And I still believe that the government could have done a slightly better job addressing the short-term pains with better targeted support rather than just waiting for it to pass and asking Nigerians to bear it. I think that was probably one of the major weaknesses of the entire system. A second key reform was the unification of, as we know, and the liberalization of Nigeria's foreign exchange market. For many years, we operated under a tangle of multiple exchange rates and administrative allocations. This opaque system created wide gaps between the official rate, which was about 450 naira to the dollar at the time, and the parallel rate, which was about 700 or so dollars to naira at the time. And only a privileged few could even access the cheaper official rate, while most businesses and households paid far more. This system encouraged corruption and rent-seeking, discouraged genuine exporters and investors, distorted price signals, and invited speculative attacks on the naira. So in June 2023, the central bank ended this multiple exchange rate system, letting the naira float at a single market base rate. This move immediately improved transparency and price discovery. It curtailed the arbitrage opportunities and signaled to the world that Nigeria's commitment to the world to a more open, rules-based FX regime. As a result, the official rate quickly converged with the parallel market rate at the time 750 to 800 naira to the dollar, eliminating the long-standing premium that had plagued the system. And though the naira has weakened further to about 1,500 naira to the dollar today, the currency's real effective exchange rate is now arguably the most competitive in decades. In practical terms, Nigeria is no longer selling scarce dollars at subsidized prices, while exporters are no longer penalized by an overvalued currency. As a result, investors are taking note, and their response have been encouraging. For example, foreign exchange reserves have increased over time. The verified FX backlogs have been largely cleared, and our reserves currently has crossed over $42 billion, which is a 3-year high. For businesses, this new system is also transformative. They no longer have to waste energy lobbying for scarce official FX allocations, and instead they can focus on productivity and competitiveness. A more competitive naira also makes Nigerian products more affordable abroad. It stimulates non-exports, discourages wasteful imports, and encourages local production. And non-oil exporters and domestic businesses that rely on imported inputs, like I mentioned, are already reporting stronger earnings. Also, Nigeria's balance of trade is reportedly improving. But here again, these reforms, though necessary, came at a painful short-term price, which wasn't effectively cushioned. We can learn from the experience of several countries. For example, Egypt, when Egypt floated its pound in 2016, inflation quickly exceeded 30% within months, just like ours. But by allowing the currency to reach a market clearing level, Egypt restored investor confidence and saw a surge of capital and growth in subsequent years. However, Egypt, unlike Nigeria, complemented its currency reform with a more efficient and better targeted social safety nets, cushioning vulnerable households from the initial spike in living costs. Importantly for Nigeria, the more transparent FX regime has attracted a surge of foreign portfolio inflows, which helps stabilize the naira in the short term. But foreign direct investment, critical for job creation and industrial capacity, will take longer to rebound as investors test the staying power of the reforms, especially given Nigeria's long history of policy reversals. Also, monetary policy adds another layer of complexity. This foreign portfolio inflows surge has been supported by the CBN maintaining policy rates above 20%. But while this strategy supports short-term liquidity and reserve accumulation, it also discourages long-term foreign direct investment, as potential investors will favor short-term high returns in government securities compared to productive investments. I mean, they would say, if I can almost guarantee 20% plus return on investment from government securities, why would I take the risk of pursuing longer-term foreign direct investment that might not even get me as high a return as the government securities in the first place, but I'll have to take a greater risk. So the result is a trade-off between short-term liquidity stability and long-term capital formation. However, I believe that as inflation gradually eases, the CBN would shift its focus from foreign portfolio inflows towards attracting foreign direct investments. They will lower rates, hopefully, in a carefully sequenced manner. In this regard, timing is very crucial. Cut too soon, and inflationary pressure could resurface. But if you wait too long, domestic investment and critical foreign direct investment for industrialization and job creation will remain crowded out. Alongside these headline structural reforms, Nigeria also needed reforms to restore monetary and fiscal discipline, which are also essential anchors of lasting stability. For much of the previous decade, monetary policy oscillated between tightening to fight inflation and loosening to spur growth, often undermined by large quasi-fiscal interventions. However, CBN has now reasserted price stability, which is its core mandate. The monetary policy rate was initially raised to 27.5%, which is one of the steepest on record, while open market operations were streamlined to mop up excess liquidity. And importantly, these actions were accompanied by clearer communication with regular policy reports, forward guidance, and transparent explanations of the inflation outlook. Again, the results are now visible. Headline inflation, which averaged about 25 to 30% in 2023-2024, has begun to ease towards the low 20s, and food inflation, while still elevated, is slowing. Now, these gains are not merely statistical. Every percentage point of disinflation protects the real value of salaries, of pensions, and savings, and reduces uncertainty for investors who must plan projects years in advance. And I believe that if we stay the course, inflation could fall to around 14% by the end of 2026, all things remaining constant. However, between now and then, the hardship on households will continue. But the lesson here, again, is clear. Reform is like curing a fever. You must endure some discomfort as the medicine takes effect. But the alternative of letting the fever rage just because the pill is bitter or the injection is too painful is far worse. A second equally important lesson here is that, which I've highlighted already, is that like some peer countries, we should match reforms with a targeted and effective social cushion to protect the most vulnerable citizens. So once again, the key is not just introducing necessary reforms, that was done, or even the important political will to see them through, that wasn't lacking. But reforms must also be carefully planned and thoughtfully implemented so that structural change is matched by social protection and long-term public confidence. No discussion of reform in Nigeria is complete without addressing the need for energy reform. Reliable, affordable power is the foundation of industrialization, job creation, and national competitiveness. In recent years, reforms in oil and gas and electricity have gained momentum, yet much remains to be done. A striking example is the Dangote refinery, which began operations and exported its first gasoline cargoes in 2025. When fully integrated into the domestic supply chains, it promises to cut dependence on imported refined products, save foreign exchange, and stabilize fuel prices. However, operational challenges still persist, which need to be resolved, including labor issues, reliable feedstock supply, transparent pricing formulas, and clear currency settlement mechanisms to ensure that it consistently serves the domestic market. The broader challenge is to achieve energy security without reverting to hidden subsidies or encouraging monopolistic practices which can materialize if competition, safeguards, regulatory capacity, and market sequencing are weak. This underscores the need for complementary policies such as strong antitrust oversight, transparent pricing, and incentives for new entrants to prevent a well-intentioned reform from reproducing the very problems it's set to solve. Electricity pricing reforms follow a similar logic. Historically, tariffs had been set far below cost-reflective levels, leading to chronic losses, leading to deteriorating infrastructure and insufficient supply. By initiating a gradual transition towards cost-reflective tariffs combined with targeted support for the poorest households, the government can begin to break this vicious cycle and move us towards a power sector that can attract investment and deliver steady, affordable electricity to homes and industries. However, decades of underinvestment, weak governance, and misaligned tariffs have left us barely a fraction of the electricity needed to power modern industry. Our electricity supply has been notoriously inadequate, leading to routine blackouts and an estimated annual economic loss of over $25 billion due to power shortages. We have been reforming this sector in pieces. Remember the unbundling and privatization in 2013, for example, but with mixed results. However, the Electricity Act of 2023 fundamentally changes the governance model. Combined with a federal plan to refinance about 4 trillion naira in sector debt, this legislation could break the logjam of underinvestment and chronic outages. The act devolves power sector regulation from the federal government to the states, allowing each of Nigeria's 36 states to create and regulate their own electricity markets. In essence, it breaks the old centralized monopoly and opens the door for states to partner with private investors to generate, transmit, and distribute power locally. States can now license mini grids and power plants to serve their regions. Now, this reform was driven by the realization that the prior model wasn't working. Even after privatization, the national regulator kept electricity tariffs artificially low, dissuading investments and leaving the power companies insolvent. However, now under the new act, like I said, states can chart their own path, perhaps inviting private firms to build generation specifically for industrial clusters or urban centers, setting cost-reflective tariffs with local buy-in and bypassing some of the inefficiencies that plague the national grid. And already, several states have either enacted or drafted laws to create their electricity markets. This, to me, is a bold structural shift, and if well implemented, it could unleash competition and innovation in the power sector. Of course, challenges still exist. Not all states currently have the capacity or resources to regulate electricity effectively, and coordination will be needed as power doesn't respect state borders. But we can draw lessons from other countries like India and Kenya, which also decentralized aspects of electricity governance. The federal government will have to support states in this journey through technical assistance and perhaps regional cooperation frameworks, and ensure that we don't simply replace a federal monopoly with 36 mini monopolies. But still, the principle of the reform is sound. Decentralize, liberalize, and let there be light. So these reforms, these examples of reforms, like I said, are gradually yielding measurable stabilization. But we also need to understand that behind the improving macroeconomic fundamentals lies the daily reality of Nigerian households, which, if we are not careful, are capable of reversing every progress or gain if the reform-induced hardships push people to their limits. Like I mentioned, poverty still remains stubbornly high. Food insecurity is still a problem. Unemployment and underemployment is widespread. And for most families, progress is measured not in GDP figures or fiscal deficits, but in the price of garri, the reality of electricity, and their children's job prospects. However, without keeping faith in reforms and moving from stabilization, which we generally have now, to structural transformation and deeper change, Nigeria risks another 65 years of low growth, high inequality, and persistent fiscal stress. But if we remain focused and keep faith with reforms, we will gradually remove the remaining binding constraints that have prevented us from realizing our potential. In the meantime, like I mentioned, the pain will be real, and it's the responsibility of government to minimize the impact. I've used this example. I use another example. It's like when people say there's no cure for the flu and that the infection must run its course. The medicines we take, whether over-the-counter remedies to ease fever or aches, or prescription antivirals to shorten the illness, they are not really meant to, they are only meant to lessen symptoms and reduce complications, not necessarily to instantly eliminate the virus. I think the same happens with reform. It has to run its course, and there are no shortcuts, and all we can do is lessen the pain. This experience with reform I described is not unique to Nigeria. Economic history shows that structural reform often follows a J-curve: short-term pain, long-term gain. Think of India's early 1990s liberalization, or Indonesia's post-Asian crisis reform. Nigeria stands at a similar inflection point. So staying the course is essential if we are to climb the upward slope of durable prosperity. That being said, while I speak of the transformative potential of reforms, I need to be clear that not all reforms are necessarily good reforms. What I'm speaking about here is good reforms. Some changes are labeled reform, but are poorly conceived or fundamentally harmful. A reform can fail not only in execution, but at the design stage because of faulty economics, because of narrow political motives, or inadequate consultation. Reforms that ignore economic fundamentals or sound evidence, or that mainly aim to win short-term political favor, belong to this category. Consider, for example, the massive untargeted fertilizer subsidies in Nigeria during the 1980s. Instead of intended to boost farm output, they encouraged waste and corruption, but never really raised productivity in a sustainable way. Also, reforms in name only can be equally damaging. In Eastern Europe, during the 1990s, several privatization drives were presented as liberalization and modernization, but in practice, they merely transferred state assets to politically connected insiders, replacing public monopolies with private sector ones and leaving true competition largely absent. Timing and sequencing are equally critical. Removing subsidies before inflation is contained or before safety nets are in place can sharply increase poverty and social tension. Inconsistent policy signals, weak regulatory enforcement, and entrenched vested interest can further erode credibility, reducing investor confidence and leaving reforms only partially implemented. Social and political dynamics also add layers of risk. Structural changes inevitably create winners and losers. Without effective communication, without compensation mechanisms, and participatory dialogue, those who bear the early costs, such as consumers facing higher prices or workers in declining industries, may resist through protests, strikes, or political pushback. So a reform intended to open markets can even unintentionally create new concentrations of power if a single firm or group gains dominant control. Finally, reforms need continuous monitoring and adaptive management. Without robust data systems, early warning indicators, and a mandate to adjust course, small implementation glitches can escalate into crisis. So in short, even technically sound reforms succeed only when backed by sound design, strong institutions, political commitment, and continuous feedback. Lasting change requires not just the courage to begin a reform, but the discipline to manage it over time and the flexibility to correct course when reality diverges from expectations. So what are the key areas of structural reform we need to either start or keep faith with till completed so as to move from current macroeconomic stabilization into durable and inclusive prosperity? In answering this, 4 interlocking reform domains stand out as pillars of long-term resilience. The first is energy needed to power growth. Energy remains the backbone of industrialization, job creation, and social progress. So reform in this sector is therefore existential for growth. And while recent legislation have been introduced to tackle these challenges, these laws on paper must translate into real-world outcomes. The second priority area is infrastructure and connectivity. A resilient economy must be well connected, both internally across regions and externally to global markets. This requires closing the country's infrastructure gaps, not only in roads, rail, and ports, but also in broadband and digital networks that underpin today's global economy. Take agriculture, for example. Stronger road and rail corridors linking our northern agricultural zones with southern ports would unlock significant value by reducing travel times, lowering transport costs, and improving the flow of food to markets. Inland dry ports and logistics hubs could further integrate rural producers into regional and global supply chains, allowing farmers to capture export opportunities while reducing post-harvest losses that currently account for up to 40 to 50% of some crops. This is why infrastructure is not just an economic necessity, it's actually a macroeconomic stabilizer. For example, in the face of localized shocks such as a drought or flooding, the ability to quickly move food from surplus to deficit areas can prevent scarcity and inflationary spikes. However, at present, Nigeria's inadequate transport and logistics system continues to impose a heavy burden. Logistics costs represent 30 to 40% of the final consumer price of some staples, meaning inefficiencies in movement are directly passed on to households. And this has profound implications for macroeconomic management, and it highlights why inflation in Nigeria is not purely a monetary phenomenon. A large share of inflationary pressure comes from structural bottlenecks, particularly cost-push drivers such as transport, energy, and logistics. Monetary tightening can only address demand pull inflation. That's the excess cash chasing limited goods. So initially, you will see interest rates increases begin to slow down inflation, if you check the history of Nigeria, until it gets to a point when inflation gets stuck and may even reverse. At this point, the excess cash has been absorbed and inflation is largely cost push. So simply raising policy rates beyond that does very little. It simply just adds to financing costs, raising production and distribution expense, and ironically, may even end up pushing inflation even higher instead of lowering it. In such circumstances, monetary policy has reached its limits. So knowing when to pause is as important as knowing when to tighten. The key is to distinguish the proportions of demand pull versus cost push inflation. This is why reforms need to be done in a holistic and integrated manner across the entire macroeconomy and not piecemeal across various sectors. How does one reform in one sector affect another? What do we do first? How do we limit the negative consequences of reform in another sector and so on? In short, fiscal and structural reforms must complement monetary policy. Only through such integrated reforms can Nigeria build an economy that is competitive, resilient, and inflation resistant. I was going to give several examples of how many countries in Africa had conducted their reforms, but I would, in the interest of time, I would skip all of that. The central point here is that it is clear that investments in infrastructure would directly improve Nigeria's competitiveness and resilience. That being said, it is projected that Nigeria will require about 3 trillion by 2050 to meet its infrastructure needs, of which for the transport sector, it's 575 billion between 2020 and 2043. To put this into context, Nigeria's entire 2025 budget is about 36 billion, and its 2024 rebased GDP was about 275 billion. So this obvious limited fiscal space means government alone cannot meet Nigeria's vast infrastructure needs. Accordingly, public-private partnerships are key. We heard the example of the National Theatre earlier today. In addition, Nigeria should consider institutionalizing a dedicated infrastructure financing mechanism. For example, a portion of savings from the fuel subsidy removal could be systematically ring-fenced for high-impact transport and logistic investments. Embedding this commitment into the national budgeting process and potentially into legislation would not only provide predictable funding for infrastructure, but also help rebuild trust with citizens who have borne the immediate burden of the subsidy removal. Infrastructure investment will also extend to, like I mentioned, to energy and gas pipelines. One specific initiative worth noting is the development of gas pipeline infrastructure and thermal power plants, leveraging our natural gas reserves. Similarly, investments in renewable energy, solar mini-grids for rural areas, for instance, will also enhance resilience by diversifying our energy sources and reaching those of the national grid. The story of Nigeria's telecoms sector is probably the clearest proof of what good reform can achieve. In 1960, we had fewer than 20,000 telephone lines for about 40 million people. By 2001, about 4 decades of monopoly under the then NITEL, we still had only 400,000 lines. Then came liberalization, private GSM operators were licensed, the market opened, and within 5 years, lines soared to over 10 million. Today, Nigeria has over 220 million active mobile subscriptions. Telecoms now contributes about 16% of GDP compared to less than 1% then, and serves as the backbone of a vibrant digital economy, powering fintech, e-commerce, and millions of jobs. This is what happens when thorough, well thought out and implemented reforms open sectors, helps to enforce competition, and leads to investment in modern infrastructure. The challenge before us is to replicate this success in other sectors, power, petroleum, and in particular mining, which are areas where Nigeria has vast potential still untapped, and which can create a lot of industries, exports, and jobs on a transformative scale. Beyond sector-specific changes, we also must improve the overall business environment so that the private sector can drive growth and diversification. This means cutting red tape, enforcing contracts, protecting property rights, and rooting out corruption in how businesses interface with government. While we have made some progress on the back of reforms like simplifying startup procedures and digitizing processes, that reform momentum needs to continue. Trade policy also needs reform. Our frequent use of export bans, high tariffs, and even border closures, as in 2019, discourages competitiveness and often entrenches hardship. While these measures have been often justified as protecting local industries or of safeguarding domestic supply, in practice, they have merely encouraged smuggling, raised consumer prices, reduced supply chain efficiency, and limited Nigeria's integration into regional and global value chains. The AFCFTA offers a chance to become a continental production hub, but success requires further reforms to lower trade barriers, easier customs and ports, and stronger competition policy to prevent monopolies and keep prices down. And this reform is particularly urgent, given the backdrop of escalating global trade wars and shifting supply chains. While disruptions in global trade present challenges, they also create unprecedented opportunities for Nigeria. Nigeria's size, location, and market potential mean it could become a preferred substitute for global firms looking to diversify sourcing and manufacturing away from traditional hubs. But to seize that moment, Nigeria must project itself as open, reliable, and a competitive trade partner within Africa under the AFCFTA and beyond as part of global supply networks. If executed well, such trade reform could transform Nigeria into a continental production powerhouse generating jobs, lowering prices, and strengthening resilience against external shocks. Security is equally under priority area for resilience. Without peace, investment flees. Growth must also be people-centered. Nigeria's current low human capital index shows why education and healthcare are vital. The Student Loan Act 2023 and cash transfers, including a 5 billion naira relief package for each state to offset fuel price shocks, are steps in the right direction towards a stronger social safety net. And we should consider using a portion of the savings from subsidy removal to deepen such programs and make them more efficient, so that reforms share burdens fairly. Job creation also hinges on private enterprise. Government can help through skills training, SME support, and sectoral reforms. The Nigeria Startup 2022 illustrates how targeted policy can spur tech jobs, modernizing agriculture with credit and irrigation, and modernizing agriculture with credit and irrigation can do the same for rural employment and food security. Finally, inclusive growth must reach every region. Without shared opportunities, inequality and unrest will erode stability. So power and fiscal reforms should empower states, while federal economic and agro-processing zones can lift lagging areas. Pairing pro-business reforms with robust safety nets and regional inclusion would make prosperity broad-based and durable. Now we have established the importance of reforms and discussed what has to be done and what left needs to be done. We might ask, would it actually pay off? Are we sure we are on the right path? And it's a valid question, especially when people are feeling the immediate pinch of higher fuel prices or a weaker currency. However, history offers a resounding yes. Good reforms do pay off, and sometimes spectacularly, if sustained and done in the right way and for the right reasons. And throughout my remarks, I've given a few examples. But before the overarching takeaway from those examples I gave is what I have said throughout my address, that good and bold reforms often entail short-term sacrifices, but they often bring long-term dividends. Countries that bit the bullet, whether it was India opening its economy, Indonesia cutting subsidies, or Nigeria itself removing telecoms from government hands, ended up far better off. Those that delay tough decisions usually find the problems only worsen. When at the last NESG, the World Bank's chief economist said that Nigeria would need to stay the course for at least another 10 to 15 years to transform its economy, everyone in the room yelled, and understandably so. So did I, and I'm an economist, and I understood what he was saying. 10 to 15 years under the current strain. You are telling Nigerians to wait for another 10 to 15 years. It's difficult to swallow. But I now thought about it. What's the alternative? Business as usual is definitely not an option. But if we make and sustain the right reforms now, by Nigeria's 75th or 80th independence, we may or may not be celebrating an economy that is vastly more prosperous and stable. But if we continue the way we were, we will definitely be headed to disaster. In economics, there's a theory called game theory. Under game theory, we are taught that the worst choice a player can make, I'm sure our well-experienced football champion understands what I'm saying. Game theory says that the worst choice a player can make is to cling to a strategy that guarantees failure, even when riskier alternatives exist. This is precisely the dilemma before us. If we refuse to reform, the outcome is certain. Economic collapse, fiscal instability, declining competitiveness. We know where we are going if we don't reform. But if we choose to reform, the path is uncertain. Yes, it carries risks and comes with pain, but also carries the possibility of growth, prosperity, and resilience. So it's like saying, if you go down this road, you are going to disaster. But if you go into if you use this other way, you have the possibility of going into disaster, but there's also the possibility that it might actually work out for you. Now, if you are faced with those two choices, it's better to take the risk. Because at the end of the day, if it ends up in disaster, you are no better off than if you continue the way you are going. But there's a possibility that you might actually fix the problem and improve your country. Essentially, game theory is telling us that when one option leads only to disaster, while other offers even a chance of success, the rational choice is clear. We must reform, but not blindly, but strategically with credible commitments, safeguards, and the courage to take the harder path today so that tomorrow may hold opportunities instead of decline. Before I conclude, let me turn briefly to the question of how we manage the present transition. Please give me another 5 more minutes. I'm not sure if that it's enough. We have heard enough, thank you. Or we are enjoying it, continue. But I would stick to we are enjoying it, continue. Even though I started off by saying denial is never a good thing, and you should face the reality. But just give me 5 more minutes. On my last. Okay. So, like I said, it's vital to actively manage this transition. And if not, even well-designed reforms risk being rolled back before their long-term benefits materialize. In this regard, effective communication and transparency is important. The government must clearly communicate what it's doing and why. People are more likely to endure hardship if they understand the necessity and see a credible plan. Second, protecting the vulnerable. I've said this many times throughout my address. This cannot be overstated. Expand and effectively deliver the social safety nets. Third, support for business and job creators. If we want the private sector to drive recovery, we may consider some short-term support for critical industries, especially those significantly hit by the reforms. Fourth is consistency and policy follow-through. This is perhaps the biggest risk. Policy reversal and half implementation is probably the biggest risk in reform. And we have unfortunately had instances before when a reform is announced but not fully carried out or reversed at the first sign of opposition. This time, we must hold firm with a listening ear, but a steady hand. And if the reform is good, then staying the course is absolutely essential. Finally, political will and inclusive leadership. Good reform requires a whole of government approach and indeed a whole of society support. Ladies and gentlemen, today is our Independence Day, so I'll end my address on an optimistic but realistic note by asking us to imagine in Nigeria a decade from now, if we stay true to good reforms with low predictable inflation, stable fuel prices, and foreign markets, budgets funded by reliable domestic revenue, an economy where public funds are channeled into roads, schools, clinics, and innovation rather than waste. In Nigeria, where our foreign reserves are strong, our naira is steady, and investors build factories, farms, and tech hubs from Kaduna to Lagos, new industries from solar panels to film, create jobs, rural areas thrive, and poverty declines as millions achieve a decent standard of living. Even our diaspora return, bringing skills and capital. But to me, this vision is achievable, especially as the tools to realize it exist in abundance. But it will only happen if we strengthen our economic foundation. By embracing market forces with a human face, that is competitive markets tempered by smart regulation and safety nets, we will align Nigeria with the realities of the 21st century. Resilience to me will mean that when the next oil slump arrives or a pandemic or climate shock strikes, we do not collapse. Instead, we absorb the heat, recover quickly, and seize new opportunities. History teaches us that there is no substitute for sound policy. No oil boom, no foreign aid, no volume of borrowing can compensate for weak economic management. But with the right institutions and choices, history has shown that even countries with far less or fewer advantages than Nigeria have prospered, and I believe so can we. That brings me to the end of my address. I thank you all for listening. Happy Independence Day once again. God bless you all, and God bless the Federal Republic of Nigeria.